United States stock markets recovered on Monday, February 1st, 2026, following a turbulent period marked by dramatic declines in precious metals and widespread uncertainty across multiple sectors. The three major indices posted gains during the trading session after experiencing sharp reversals on the previous Friday. Investors navigated a complex landscape involving precious metals, volatility, cryptocurrency declines, corporate earnings announcements, and questions surrounding Federal Reserve leadership. The Dow Jones Industrial Average climbed approximately 1% during Monday's session. This translated to an increase of more than 450 points. The broader S&P 500 index added roughly 0.7%. The technology-focused NASDAQ Composite moved up 0.8%. All three indices shook off negative sentiment that had prevailed in pre-market trading, particularly affecting technology stocks. The recovery came after all three major indices suffered sharp reversals on Friday, January 30th. That session saw precious metals experience severe declines that created ripple effects across financial markets. Gold and silver prices had skidded dramatically, unsettling investors and contributing to broad-based selling pressure in equities. Wall Street entered a new month facing multiple sources of uncertainty. Questions surrounding NVIDIA and the broader artificial intelligence sector weighed on investor sentiment. NVIDIA's chief executive officer, Jensen Huang, addressed reports regarding the chipmaker's previously announced commitment to invest $100 billion in OpenAI. The Wall Street Journal had reported that this investment plan was on hold. Huang played down the significance of the reported delay. Despite his comments, NVIDIA shares experienced declines during the session. Technology companies have driven market movements throughout the early portion of 2026. Earnings reports from major corporations have pushed individual company stocks in opposing directions. A significant wave of corporate earnings was scheduled for the week, creating both opportunity and risk for investors. Amazon, Alphabet, and Advanced Micro Devices were all scheduled to report quarterly results during the week. Disney and Palantir released their earnings reports on Monday. Pressure on equity markets began to ease amid a roller coaster pattern in precious metals markets. Gold and silver prices seesawed during Monday trading. This volatile action followed a devastating Friday session that saw silver post its largest single-day decline on record. The dramatic movements in precious metals unwound much of what had been among the strongest rallies of 2026. Gold futures and silver futures both experienced wild swings. The precious metals had attracted significant investor attention during January as prices surged to extraordinary levels. The subsequent collapse raised questions about the sustainability of recent gains and the factors driving price movements in these markets. Cryptocurrency markets also experienced significant turmoil. Over the weekend, Bitcoin dropped below the $80,000 mark. This represented the first time the cryptocurrency had fallen below this level since April of the previous year. The decline extended losses that had begun during a volatile period at the end of the previous week. Bitcoin was most recently trading above $78,000 per token. Currency markets reflected the shifting dynamics across asset classes. The United States dollar gained strength against major peer currencies. The dollar index, which measures the greenback against a basket of other currencies, posted increases. The dollar rose most sharply against currencies that tend to be sensitive to commodity prices. This pattern reflected the broader decline in precious metals and the resulting impact on commodity-linked economies. Investors were also attempting to assess the implications of President Trump's nomination of Kevin Warsh to lead the Federal Reserve. The president announced this selection over the weekend. Market participants view Warsh as likely to pursue efforts to reduce the Federal Reserve's balance sheet, which currently stands at $6.6 trillion. The nomination also opened questions about the future path of interest rate policy. Despite this uncertainty, most traders continue to expect 2 interest rate cuts before the end of the year. Economic data released on Monday provided some positive news for investors. 2 separate readings of manufacturing sector activity showed unexpected improvement in January. Purchasing Managers Indexes from S&P Global and the Institute for Supply Management both indicated stronger conditions than economists had anticipated. These indexes saw their sharpest increase in production since May 2022. The data suggested resilience in the manufacturing sector despite various headwinds facing the economy. The week's most important economic data release faced an unexpected complication. Friday's monthly employment report was set to be postponed. The delay resulted from the United States government entering another partial shutdown. This development created uncertainty about when investors would receive crucial information about labor market conditions. Later in the Monday session, stocks pushed higher following an announcement from President Trump regarding international trade. The president stated on Truth Social that the United States and India had reached a trade agreement. Under the terms described by the president, the United States would reduce the baseline tariff rate on imports from India. The rate would decline to 18% from 25% previously. In exchange, India agreed to stop purchasing Russian oil. Trump also stated that India would move forward to reduce its tariffs and non-tariff barriers against the United States to zero. The trade agreement came after President Trump spoke with India's Prime Minister, Narendra Modi. The announcement represented a significant development in the administration's approach to trade policy. Just 1 week earlier, India had secured a trade deal with the European Union. That agreement had been characterized as the mother of all deals. The strengthening of ties between the European Union and India had been interpreted by some observers as a rebuke of the United States. The European economic bloc has sought to diversify its trading partners in recent years. The delay of the employment report created complications for economic analysis and policy discussions. The Bureau of Labor Statistics announced it would postpone the scheduled Friday release of the non-farm payrolls report. Emily Little, an associate commissioner at the Bureau of Labor Statistics, issued a statement confirming the delay. According to Bloomberg, Little stated that the release would be rescheduled upon the resumption of government funding. Due to the partial federal government shutdown, the Bureau of Labor Statistics would suspend data collection, processing, and dissemination. The United States government entered a partial shutdown on Saturday, February 1st. This occurred just over 2 months after the government had reopened following the longest shutdown in the nation's history. That previous shutdown had created havoc for economic data releases. Agencies were still working to catch up from the disruptions caused by the earlier closure. Most analysts expected the current shutdown to be short-lived. Republican House Speaker Mike Johnson expressed confidence that he possessed sufficient votes to pass a reopening measure. That measure had already been approved by the Senate. If Johnson's assessment proved correct, the government could reopen quickly, limiting the disruption to data collection and release schedules. In corporate news, 2 major retailers entered a new era as their new chief executive officers assumed control simultaneously. At Walmart, the nation's largest private sector employer, John Furner stepped into the chief executive officer role. He succeeded Doug McMillon, who retired on January 31st after more than a decade leading the company. Furner is a longtime Walmart employee who began his career as an hourly associate in 1993. He served in various roles within the Sam's Club division before taking responsibility for United States operations. At Target, former Chief Operating Officer Michael Fidelke succeeded Brian Cornell as Chief Executive Officer. Cornell stepped down after more than a decade running the company. Fidelke faces multiple challenges at the beginning of his tenure. These include declining sales and a crisis in Minneapolis near Target's downtown headquarters. The 2 retailers were once considered close rivals in the big box store category. However, their fortunes have diverged significantly in recent years. Target's stock has declined 42% over the past 5 years. The company did experience a major boost during the pandemic, but gains from that period have been erased. Walmart's stock has increased by more than 150% over the past 5 years. Walmart has focused on staples such as grocery, e-commerce, and delivery services. The difference in performance is reflected in market capitalization figures. Target's market capitalization stands near $48 billion. Walmart's market capitalization has reached $970 billion, approaching the $1 trillion milestone. The manufacturing sector data provided welcome positive news amid broader uncertainty. Activity in the United States manufacturing sector grew for the first time in a year. The data signaled unexpected improvement and resilience as companies built up inventory levels. The Institute for Supply Management's Purchasing Managers Index expanded to 52.6% in January. This exceeded economist estimates of 48.3%. It also surpassed the previous month's reading of 47.9%. Another reading of the Purchasing Managers Index from S&P Global recorded 52.4 in January. This represented an increase from 51.8 in the previous month. Manufacturing Purchasing Managers Index readings are considered a leading indicator for broader United States economic activity. Readings above 50% indicate expansion in activity. Readings below 50% signal contraction. The Institute for Supply Management's New Orders Index grew for the first time since August. The index increased 9.7 percentage points to reach 57.1% from December's reading. The Production Index rose 5.2 percentage points to 59.9%. The Prices Index also climbed moderately. Tariffs and elevated prices remained key themes among purchasing managers surveyed for the reports. Survey respondents often linked elevated prices to tariffs. Chris Williamson of S&P Global noted that while businesses remain hopeful that demand will increase later in the year, political uncertainty has continued to weigh on near-term sentiment. Expectations among business leaders have held up despite current challenges. Williamson highlighted an unusual pattern in the data. Over the past 3 months, the survey indicated that factories have typically produced more goods than they have sold. The degree of this imbalance has not been seen since the global financial crisis in early 2009. Williamson characterized this situation as clearly unsustainable. He suggested it hints at risks of a production slowdown. There could be potential knock-on effects on employment unless demand improves markedly in the coming months. Currency markets showed additional movement following the Federal Reserve announcement. The United States dollar index continued to recover after Friday's announcement regarding Kevin Warsh's nomination. The index, which measures the dollar against several currencies including the euro, Japanese yen, and British pound, rose 0.4% to 97.41 on Monday morning after markets opened. The dollar's stabilization followed a period of decline in the latter half of January. Geopolitical concerns around Greenland contributed to the currency's weakness during that period. Some market observers viewed the sell-off as potentially having gone too far in a short time frame. Patrick Ryan, chief investment strategist at Madison Investments, shared his perspective on the dollar's outlook in an interview with Yahoo Finance. Ryan acknowledged that episodes of dollar strength would certainly occur, particularly if the Federal Reserve were forced to adopt an extended pause in policy changes or if inflation were to reverse course later. However, he indicated that his firm was currently positioning portfolios to take advantage of dollar weakness. Ryan stated that the dollar should serve as a tailwind for investing overseas and for seeking weak dollar plays. His firm has been taking advantage of these opportunities in portfolio construction. A strong jobs report on Friday could provide additional support for the dollar's stabilization. However, the government shutdown created uncertainty about when this data would become available. The timing of the report's eventual release remained unclear as the shutdown continued. At the market open, stocks initially nudged lower. The Nasdaq Composite dropped 0.2% in early trading. The S&P 500 fell about 0.1%. The Dow Jones Industrial Average hovered just below the flat line before reversing direction to trade up 0.2%. The early weakness reflected ongoing concerns about precious metals, artificial intelligence trade developments, and Federal Reserve uncertainty. However, the reversal and subsequent gains demonstrated resilience among equity investors.